Fund Supermart, your online gateway to unit trusts.
The fund aims from lower portfolio volatility relative to the MSCI All Country World Index. How does such a strategy benefit investors, and how would the fund's return profile differ from other global equity funds?
Well, the key to investing in global equities is to do it for the long term. Traditional global equity funds often suffer from drawdowns, and those drawdowns sometimes crystallize an exit at an inappropriate moment for investors. Either some risk model or just some emotion means they sell out at exactly the wrong moment. So a lower volatility portfolio enables investors to hold on for the long term. The drawdowns are shallower, and therefore the recovery period is quicker. So this is the key differentiator for a low volatility portfolio.
How would the fund's return profile differ from other global equity funds?
Well, over the long term, I think it will provide a better return, a better risk-adjusted return. It will be a smoother ride. Of course, in periods of strong momentum, this strategy, which puts less risk out there, invests in companies that have higher levels of profitability and a lower beta, will likely lag. But actually, the important thing is that during the downturns and downdrafts, it will protect better and therefore recover quicker. So it will have a different return profile, so people should think about its place in their overall portfolio.
What is your outlook for global equities? Are there any favorite or least favorite countries and sectors?
Well, I think our outlook for global equities as an investment house is framed within the other investment choices today. If you're after safety assets, they offer very poor real returns. So faced with that alternative, global equities with a real return still look attractive, despite the fact obviously they've become more expensive than they have recently.
Does the fund incorporate macroeconomic news and expectations in the portfolio construction?
The fund is a bottom-up driven portfolio, and of course the individual stock selection by the analysts includes an element of macro factors as they influence the profits and losses and trading of individual companies. However, the overall screening process for the portfolio looks at companies that have a favourable combination of profitability and valuation, and therefore can skew the overall asset mix of the portfolio from one part of the world to another. So for example, we've just rebalanced the portfolio, and having been overweight the US, we're now underweight the US because the US looks a bit more expensive than it has done historically. And that incremental capital has been redeployed, for example, in Japan and in emerging markets, and a bit more in Europe. So there's a bit of a shift from the US to those other regions.
This volatility strategy is relatively young in Singapore since its launch in June 2014. Which investment contributed most to its returns, and which was the largest detractor to its performance? Is the fund still holding these companies in its portfolio?
Well, the capability we've been managing for nearly 3 years. You're right, in Singapore the strategy is relatively newer. I think the interesting thing to note is that the returns have been spread across a wide variety of sectors. Traditionally, you'd expect returns in a low volatility focused portfolio to come from defensive areas, but interestingly, a lot of our returns have come from some of the more cyclical areas. We deliberately target investment attractiveness first, and only then do we consider lowering the overall volatility of the portfolio. So in the last year, it's the same story has been repeated. It's been a balance between cyclical sectors and defensive sectors. And the fund's holdings have actually remained quite stable. We typically turn over maybe half the portfolio every year, but some of the stocks therefore have stayed in for more than 1 year.